From the morning reading, investors have driven high-yield closed-end bond funds to the widest discount from their underlying values in years. It has been rare to see investors demand such a discount over the past 25 years, which almost always proved to be an overreaction to the worries of the day. Active investment managers are only 21% net long stocks. According to the NAIM, the average manager has reduced their exposure to stocks from being 99% net long in February to 21.3% net long this week, the lowest since October 2014 and the fourth lowest since the bull market began in 2009. Since the survey's inception, when exposure was this low, stocks rallied over the next month 71% of the time, averaging 2.7%. The only persistent losses occurred in 2008 when these managers had correctly reduced positions ahead of the worst losses in the fall. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:05 a.m. Central Time, and I'm recording this in preparation for the market day of September the 25th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into our morning report, see just what's been happening in the overnight action. In terms of the four broad market U.S. indices, very, very bullish. And these are the kinds of things that happen especially in bearish market times. You'll wake up and you can be down 30, or you can wake up and you can be up 30. It's important to remember that some of the most bullish days on record occur during bear markets. And indeed, at the time of this cut, we were up over 21 points. At this point, we're actually up right at 28 points. So this trend has continued from the overnight into the present. So the ES is currently up about 1.4%. The NASDAQ up about 1.34%. Russell 1.3%, and Dow up over 1.5% live action as of this time. In terms of crude oil, it's up at the time of this cut about 0.75%. Euro down about 0.5%. Bonds down about 0.5%, and gold down approaching 1%. In terms of overseas action, China down about 1.6%, Hong Kong down, up about 0.4%, Japan going the totally different direction from China, up about 1.75%. Europe on fire. Germany's up about 2.6%, United Kingdom up about 2.5%. So huge bounces on that front. In terms of macroeconomic report for today, you have the final GDP number at in about 25 minutes from now, and then you have during the cash market open, you have the University of Michigan Consumer Sentiment, so be aware of that. In terms of current volatility conditions, we have skew still very high, not over the 135 that we had yesterday, but you do have it still well up over 130. Short-term VIX also up from what it has been in recent days, 24.22. Though the IV percentiles are relatively benign at less than the average for the year. You got a 40 on the S&P, 36 on the Russell, 39 on the NASDAQ, and 48 on the Dow. In terms of standard deviation moves, no standard deviation moves were put in by any of the broad market indices yesterday, though it's important to note that there was quite a rally during the day yesterday. And you notice, look at this big wick, and that usually means, at least for the short term, that we're likely to have a reversal. And the fact that you have this this hammer pattern with this really long wick, followed by the overnight action that we have right now, that would be expected to be the early morning confirmation that you're looking for, as a confirmation of this reversal candle. And this seems to be setting up for at least a leg up for at least today. Now, whether this forms a lower high and ends up just being another bear flag and a continuation down to the prior lows, that would probably be the lead argument at this point. But it'll be very important to see just how high this goes, and indeed, does it set a higher high, or does it roll over prior to this 2018 area on the SPX. Right now, we're trading on the E-mini futures at about 1945. So going to be some pretty interesting action. Looking forward to that. Now, that wick was also seen on other indices yesterday. Here's the Russell, another wick as well, Doji. In fact, if I remember right, I want to say that could be a dragonfly doji. And remember, dojis and reversal candles like this need confirmation, but that looks to be coming true this morning. NASDAQ actually had a green candle yesterday, so quite a reversal pattern put in on the NASDAQ yesterday. And then, of course, the Dow also a hammer reversal looking pattern. So pretty interesting action yesterday. But note here, let's go to the 5 minutes. And on the futures contract, and let's actually change this to the futures contract. You notice where we bounced. Now, a couple things here. First of all, this is right when the European market closes. And as it came into the European market close and a very, very important support level at this 1900 area. This was a round number. Often round numbers like 1900 serve to be very important. The other aspect to this is that there was some prior support. You notice, and I already had this drawn prior to this action yesterday, but there's a 618 fib retracement. There were a number of factors coming together, and we call that confluence. And when you have a cluster different kinds of technicals coming in together to form a confluence, it often serves as a powerful support or resistance area. So this was not a bit surprising that it bounced. I was watching and actually closed out a trade, a short trade for profit in this area yesterday, and took targets. And then we saw this reversal. Now, there's also, Yellen was out there and gave a speech yesterday as well, and this is part of this action likely in the overnight. And she made a number of interesting comments, as a matter of fact. But so a combination of things. People perhaps providing new information into the market, but also technical levels of support coming into play. But consider where we are. We're playing up here. We've been up here as high as the 1951 area, and we were at 1897 at 10 o'clock yesterday. So some, 20 odd hours ago, we've now gone 50 points on the S&P futures since that time. So that's a pretty dramatic change in a relatively few number of hours without something more dramatic coming into the market. And to go up 50 points is even more dramatic than going down 50 points, because you don't normally see the markets explode up. In terms of a regular daily guide, still, trend breaking phase 2 is the expectation. Portfolio investor posture opinions are IBD status, uptrend under pressure, accumulation distribution for the S&P still remains D-, NASDAQ and E. GMI index remains a 0 out of 6. That author still remains in cash, and the primary market condition still remains strong bear. In terms of decision point scoreboards, still lots of down red arrows, no changes from yesterday. Consensus opinion between these various opinions, both subjective and mechanical, would give us a strongly bearish kind of overall portfolio investor posture. In terms of the intermediate term market posture, it is also bearish at this time, and indeed you see S&P 34 in bearish, Dow 43 in bearish, Russell 37 in bearish, NASDAQ weekly bearish at a 59.4. Position sizing opinions remain at 50% based on both signals, volatility and our regular portfolio position sizing opinion. Hedge warning status remains level 2, which is red light. So significant risk still in the market, and yet remember that this is not a prediction of degree of downside action or that we indeed will go down any significant degree. It's just that the risk conditions are present to have a sharp down move at any time. In terms of the specific metrics, under the volatility area, we still have several warnings. Market and decline and sharp increase warning both present. VIX is still up over 18. Most notably, we had another distribution day, and indeed S&P was at a 5 now, and NASDAQ also at a 5, and this is really quick to go from a reset count all the way back to 5, which is where our warning level triggers. So this is definitely not a healthy bull market when you have this kind of action. Remember, this all started with IBD going to confirmed uptrend, and then that confirmed uptrend only lasting a whole of one trading session before deteriorating back into uptrend under pressure. Once that uptrend under pressure was triggered and this reset of distribution day count started again, we went from 0 to 5 in really quick action. Skew still up over 130. Look at this, new highs, new lows. Yesterday, not only over 300, but twice that. New lows 659. Now, very important to understand, while these various metrics were triggered yesterday, we did have a huge reversal, and we are 50 points higher than that action that triggered most of this kind of metric. So we'll see if we get this bullish short-term bounce, and whether that is just an opportunity for the bears to reload and take new short positions, or if indeed the bulls actually have something that they can carry forward to a new high. In terms of risk aversion indicators, all 5 are now risk off, so that is not a good sign for the bulls as well. In terms of special opinions, no changes from yesterday. VIX is still outside the acceptable window for novice traders to initiate option income strategies. For more experienced traders, obviously the increased volatility is welcome as being able to bring in additional premium. Cover calls and put selling, again, conditions borderline acceptable to initiate new positions for novice traders. Consider reduced position. Consider using in-the-money strikes for covered calls. Consider even more so legging into those covered calls through the use of selling puts and then accepting assignment on stocks that you're willing to own in the position size that you're willing to own it. In terms of put selling, very much the same approach right now. Aggressive traders consider scaling into positions and spreading off those puts. Don't just have a naked put, but consider buying a cheaper long put and define that risk in the current market conditions especially. In terms of sector specific, you see a sea of red still here. Utilities, of course, is the one that is popping up here in some green on the short and intermediate term. Utilities, of course, will benefit from any kind of expectation that interest rates will not rise in the near term. However, that could unravel quite quickly if those interest rates do start to increase. And remember, it's not just dividends with utilities, but they're also hit with very heavy debt loads. They have to build those utility plants, which often take decades to pay for. And they're also hit with an enormous amount of regulation from the EPA, especially if you're one of those hated by this administration coal plants. In terms of sector percent change, you have utilities, energy yesterday, and consumer staples putting in positive days, but quite a spread here. So that should be enough for today. If you find what we're giving you is helpful each trading morning, we greatly appreciate your recognition of that by retweeting us to your Twitter followers, to your StockTwit followers, liking us on YouTube, subscribing to us on the YouTube channel, and the other social media platforms that are available to you. In terms of feedback, direct feedback can be sent to support@falconglobaltraders.com. More information about how we apply these principles can be found at this website. Free trials are available. Disclaimers as always, hit the pause button if you need more time to review this. And we'll look forward to seeing you back here Monday morning before the market opens with the Falcon Global Market Preview. Good trading.